So real estate continues to be an appealing asset class for everyone. I definitely agree with that because it is the number one way to build your wealth, whether it is your own home, which is one of the largest part of your wealth building venture, if you would say, or investing in various types of real estate. Today, we are going to cover capital gains tax on real estate, long-term, short-term. We are also going to cover something that is very, very interesting to all investors out there, all people that think about real property, and that is the 1031 exchange. I've got this question asked to me so many times, and there's so many misunderstandings about a 1031 exchange that I want to clear up today. Also, our third thing that we're going to talk about is one of the ways to save on capital gains with estate planning and wealth planning, and it's called the stepped up basis. This is Sherron, the Modern Savvy CPA, and today we are going to be talking about all things real property assets. The thing we're talking about today is capital gains tax. Now there's two different rates for capital gains. There's short-term capital gains and long-term capital gains. That depends on how long you're holding an asset for. So short-term capital gains apply to if you own a property for less than a year. Short-term capital gains rate is the same as the ordinary tax rate. When you're going to see a sample of your short-term capital gains rate tax table shortly. The next thing we're going to talk about is long-term capital gains rate. Long-term capital gains is when you hold an asset for at least 12 months. Long-term capital gains rate is a lower tax rate. It can be as low as 0% if your taxable income is low enough, or it can be as high as 20%, depending on what your income tax bracket is. So it just kind of depends on how long you've held the assets for. That's one of the things that you want to think about when you're holding an asset. Is if you want to be able to hold the asset for the longer period, if you can hold it for more than a year, it's best to hold it for more than a year and get the preferential tax rate. So real estate falls under capital gains, short-term or long-term. Also, stocks and bonds fall under capital gains. That's short-term or long-term. It's the same time period. You want to think about that. Now, real estate is an example of real estate would be land. So if you own an empty land and you've held it for investment and you've keep it for a while, if you have it for less than a year and you try to sell it, then you're going to be thinking about ordinary income tax rate to be taxed on that. That's short-term capital gains. If you are hold it for more than a year, then you're definitely going to be thinking about long-term capital gains, which can be as much as 20% depending on your tax bracket. Again, please look at the tables to understand your tax brackets that's on here. So these are the things that you need to think about when you're thinking about real estate, especially. So what else can be real estate? What else can be real estate each taxed at long-term or short-term? One is land, yes, a loan. Land does not depreciate, so it's very simple to calculate the capital gains on land. It would be whatever you sold it for. So let's just say you've sold the land for $500,000 and you bought it for $300,000, and you've held it for investment. If you've done some improvement on the land, then that would be a cost. So usually your capital gains is your selling price less whatever you paid for it, less any expenses from when you bought it, less the selling cost. So just, if you paid real estate commissions and stamp tax or transfer tax or anything like that, you have to take that off, and then you will end up with your capital gains. And that is where the rate will be implementing depending on if it's short-term or long-term. Now we have other types of real estate. We have people investing in rental real estate. Rental real estate is also taxed similarly to land. There's capital gains, short-term or long-term, the same thing. If you've held it over a year, it's long-term capital gains. One thing that is on rental real estate, and if it's residential rental real estate, then there is depreciation to consider. If you have taken advantage of your rental real estate and have been reporting it on your tax return, which you should be reporting it, the depreciation is allowed or allowable. So whatever the depreciation calculation is that you have taken as expense over the years, you will have to recapture that, and that is taxed at your ordinary income tax rate, section 125. So that just kind of depends on where that is. So for the most part, your gain on the property will be capital gains, taxed at capital gains, short-term or long-term with rental real estate. Rental real estate is depreciated by 27 and a half years, plus any improvements. Depending on the improvement, you can cost segregate the improvements and depreciated at a shorter time, which is preferential also. So you definitely want to talk to your tax advisor or your trusted advisor, your financial advisor about when you own real estate, because now your tax becomes complicated. It is not something that I recommend you do yourself, because there's always little things that you can do wrong that can cost you a lot of money. I see this all the time. A person owns a simple rental property and they think that they can do their tax return on their own, and they mess up the depreciation part. And trust me, you will lose out during the years if you mess up the depreciation part, and you will lose out in the end when you sell the property if you mess up that part. So you don't want to be trying to do that yourself if you are not knowledgeable about that. You need to seek a proper advisor, a CPA, an EA, to be dealing with that in your taxes, if that's what you're looking at. So that's rental real estate. Now there's also commercial real estate that you can deal with. Commercial real estate is depreciated on a 39-year level, and it is the same things that falls under: long-term and short-term capital gains rates. So if you own a business and you do own commercial real estate within that business, you most definitely want to see a CPA on that, because that does not just involve taxes, it involves all sorts of financial consequences and financial planning that can save you a lot of money and help you in terms of your wealth building assets. When should you sell? When should you not sell? What are you renting it for? There are so many questions that are involved in that. So that's capital gains. Please look at the tables that I've provided at the end here to understand short-term capital gains and the brackets and the rates, and long-term capital gains, the brackets and the rates, so you can have an overview. Of course, having an overview is understanding. It's just like you having an overview of your physical health. You understand your body, you know what to put in it, but you still need to talk to your doctor, you still need to make an appointment, and sometimes you need medicine. So it kind of depends. It's the same thing when it comes to financial health. And you need that trusted advisor to give you the advice, tell you what you need in terms of where you're at. You have ideas, overall idea. You should always have an overall idea about your business and your finances. That is what I'm trying to teach you here. But you still need to make sure that you are seeking trusted advisor information, trusted advisor knowledge, trusted advisor experienced, trusted advisor information. There's a lot of noise out there on the internet, on social media, and everything, on everyone trying to give you financial advice, trying to teach you financial literacy. You need to vet them. You should not take advice from people who are just coming out of school and just trying to give you advice, or people who have experienced one thing in their life and they're trying to tell you advice. You want to make sure you have someone that has the education to back them up. And you want to make sure that you have someone that has the experience, that have seen different people, different clients, different situations, so they can tell you what the pros and cons of certain things are.